the microfab experience. So, the reason we started this out entirely was only to understand how can deep dive conversation about literacy, about finances, about building across borders can become easier for all of us. And to make that a reality, we are joined by the most amazing person out here, Mr. Anirudh Gupta. He would be the leading author in 2026. He has contributed to more than 200 plus articles. He has an experience of more than 21 years across financial industry, across investing. He's the author of Design Your Destiny. And at the same point in time, any mentorship that anyone seeks in terms of understanding how to learn the art of retirement that we're going to talk about tomorrow, we are joined by one of the best speakers who has been at platforms, spoken and addressed to more than gatherings of thousands all across the country. It's a pleasure to have you with us, Mr. Andrew, today.
Thank you.
We would love to understand, like when you started authoring your book and started into the entire finance space, and you thought that you would like to talk about, understand, or firstly initiate the topic of retirement. Why was that one of the major things amidst your career around all of this?
See, basically, if you look at it, there's no financial security in our country. If you compare any developed country, there is some sort of financial security.
Right.
So you're working in your peak years and they take care of you when in not so peak years. But then there also people plan for their retirement. For example, like people in Germany or people in the US, they still plan for their retirement despite the money coming to them through the government system. They do have their 401ks, they have their mutual funds, they have their stocks, they have their bonds, which helps them diversify.
Understood.
So
So to
you have to be ready for all situations. Eventually, the lifestyle you want to live is your choice.
right.
And for living the lifestyle you want, you need to be ready to be prepared to pay the price in terms of being ready financially. If you look at it, 90% of the people in India, if it was not for the fact that family is the best form of support, would outlive their savings. I'll give you a simple example.
Right. Okay.
So let us say somebody has an expense of 1 lakh rupees today per month. That expense at the inflation rate of around 10% doubles every 6 7 years.
Okay.
7 8 years you can say.
Mm-hmm.
Basically you are spending for the same lifestyle, it becomes 2 lakhs, but it is very rare that your lifestyle remains the same. It keeps on changing every couple of years
Correct.
as your income increases. Or sometimes people take loans to fund their lifestyle.
Right.
So I'm not being critical on the approach, but bottom line is that your lifestyle increases. So essentially,
Right.
for a period of 20 years, your expenses would increase by 5 to 10x depending on your lifestyle increase.
Understood. So now when I try to understand this on a deeper level, like since you bring almost more than a 2 decade experience with working across so many different domains in this space. When we try to understand investing space, it is so much about the right funds, like invest in your mutual funds, have a forex portfolio, get into cryptocurrency. Because when you talk about big corporates like real estate or other things, initially it is not possible for someone to immediately acquire the right funds to actually get in that space of investing
What
like
happens
that.
is that you don't need to start in a big way, but your approach has to be right.
Okay.
So, what is the right approach? Right approach first is you should have emergency funds for 12 months
Okay.
of your fixed expenses. That's the first step. And then you can take risk as per your risk appetite. You look at other areas. We are not really gung on crypto, but
Right.
from that, you take equities or you take mutual funds. You take a PMS. You take an AIF. You take startups as an asset class, basis valuation. On that we are okay with. But then we come with a disclaimer that let's say you want a 20% gain, you should be ready for a 20% write off. If you want a 100% gain, you should be ready for a write off of your capital also.
So how do you figure out that the safest possible way to make it happen. Let's say we have a certain corpus with us. How do we make sure that we actually have that corpus out there? Or, okay, this is like, how does the math work behind the concept when you guide your
The concept
mentees, when you guide
is
people
that
all around?
at any given point in time, we are, as a investment philosophy, we are not taking a risk on your capital. We are taking a risk on the returns you might make. So instead of 20, it might be 15, it might be 10, depending on the market cycle, or it might just stay still for some time. Markets might go through a time correction instead of a capital correction, like they are going now.
Understood.
So
So when we understand like the markets, how do you deep dive on it? Like when you try to understand all these aspects, how does your deep dive approach look like to anyone?
first is we start with asset allocation in terms of, are you ready with emergency funds? Then we talk about riskier assets. Then we talk about your risk tolerance. And then we look at what the trends are, basis fundamental, technical, and macro. So that is the broader approach which is factored in, and that out of that approach, a recommendation comes out that this is the right thing. And then above all, we look at what is top quartile. Top quartile is top 25% of the investment choices available to you. So when we do that, and when we think that it's top quartile over a period of say 75% of the fund life, then we try to recommend it to you. What is the benefit of that? You see consistency in the portfolio, and even when markets are volatile, it tends to bounce back faster.
So if there is one person who does not have a lot of understanding, and if you had to provide them with a roadmap, like if
Okay.
someone who's 25 right now, and
Okay.
you have to give them a roadmap of, okay, by let's say 35, we work on ensuring that you move towards that retirement plan with you start
See,
with this amount and you end up with this amount. So what is that roadmap? Like how would you plan a roadmap for, let's say, someone like me, or someone who's
okay.
an entrepreneur in mid 20s and they're looking to get an early retirement, or let's say even then they're mid 30s but they feel they want to free up their 40s. So how would that roadmap look like for them?
See, it starts with the first crore. The first crore is the most difficult number. So generally, for most people, you have loans, you have liabilities, and
Right,
in the mid 20s, you get married by the time you're 30.
right,
So essentially, you'll buy a house, so you'll take a home loan jointly or otherwise.
correct.
So you will have a loan which will take another 15 years to be cleared. So what can you do simultaneously is you can invest on a regular basis,
Okay.
automate your investments, get to your 1 crore in a period of 8 to 10 years. So let us say you are earning 1 lakh, for example. You are saving 30% of that.
Right.
You could park in most of it in growth assets. Over a period of 7 8 years, you get to 1 crore.
Okay.
If you are taking an aggressive approach, if you are taking a medium risk approach, it will take you 10 years. If you are taking a conservative approach, it will take you 12 to 13 years, 12 to 14 years.
But when we consider inflation as well, like to maybe 1 CR as an amount right now, which is equivalent to 100K in dollars as well. So
Correct.
now that's like due to the inflation rates, it does change a lot as well. So when you talk about your first CR,
Okay.
how do you ensure that someone can acquire it in the fastest way possible with what strategy implementation? So
See, there
what
are two
should they be
types of
like
strategies
starting with?
which are there. One is a multi-cap strategy, which is say about 50% large cap,
Right.
and the rest is 50% mid and small cap. So depending on your risk appetite, small cap can be 30%
Correct.
or mid cap can be 40%. So that is an aggressive approach relatively. That gives a return of close to 20% over a 10-year period. So when you look at a 20% CAGR, it's around 6 times roughly the money.
Right.
So let's say you have invested, say 20 lakhs you invest today, for example, or 10 lakhs you invest today, for example. Over a period of a decade, you'll have around 60 lakhs with you. 50 to 60 lakhs is what you will have with you if you take an aggressive approach.
Right.
But let's say you are taking a conservative approach or a moderate to medium risk approach. So that's a flexi cap approach where around 70% would be large cap and the rest will be mid and small cap. This ensures that your portfolio is stable, it's not so volatile. When markets fall, you will not react that badly. So basically, you stay invested. That's the route from which most of the investors take.
Understood. Okay.
But then, let's say you want it faster and you want it in 8 years instead of 12 years,
Right.
then you take the multi cap approach. So instead of 50, you could probably tweak it to 55 large cap, and the rest is, say, 40% mid cap and 5% is small cap. Or you can say 55% large cap, 35% mid and small cap, and 10% is crypto. We don't recommend crypto, but if you ask me, one of the ways you could do it is that. Because हमारे कहने से तो कोई सुनता नहीं है.
Right,
People,
absolutely. But
every
why is there an angst against crypto? Like, I have a friend who's about to, like, almost a crypto millionaire. I have someone who has built his own crypto coin is in Dubai and is a bill. Like, I'm not trying to drift away, but just I'm very curious around this. So, why do you think there is a lot of stigma around not investing in cryptocurrency? Is it because of the volatility or big?
the traditional way to predict it, anybody can operate it. Anybody with a sufficient amount of capital can operate a currency. So it can go up, it can go down. Now most
Right.
people cannot take that volatility. Now assuming you can take that volatility, you take the volatility. But then it's not a currency or it's not an asset or it's not an asset class.
So, do you think crypto has a future in general when it comes to like someone who's investing
There's a lot of money.
30% of their corpus into cryptocurrency only?
See, there's a book called as Kings of Crypto. Readers can, or people who watch, they can have a read at it if they want to understand crypto in depth, because that itself is a topic for 3 hours. But yes, there's billions of dollars behind it, so it's not going to vanish overnight, but it's going to be very volatile. So if you're okay with the volatility, you stick with it. I've given you the crux of it.
Right. That makes sense. So, coming back to the point wherein you majorly focus on like ensuring the best way possible to ensure that this is the person how they can retire. So, when it comes to classification, like most of the people have a stigma around investing in general, or they are confused as to how to make the first investment or how to like start with it. So what are the safest measures you recommend people that do this, do that, do this, then once you get a hang of it, go bullish on it?
I'll give you a better approach to it. We have a four-layered biryani approach.
Okay.
So biryani, of course, sounds tasty. It's dinner time. I didn't have my dinner, so it's a good analogy
Right.
also.
Right.
So coming down to the analogy, one is you should have fixed income which takes care of your dal roti.
Correct.
Basic expenses like your society maintenance, your electricity bills, telephone bills, internet, and the like, your AI bills, all those kind of things should be covered by all of that, and your food and grocery. So that should be covered in your fixed income expenses.
Correct.
So you're never at stress over basic things. So that's the first step. Second step is you can have rental property or REITs. See, most of us will not park in a lot of money at age 25, will not park in a lot of money in a real estate property and give it out on rent. Starting point in most cities is 1 crore and above.
Right.
Whether you take a place like Noida where I'm sitting right now, or whether you take a place like Chennai which has a 2 BHK or 3 BHK at 75 lakhs. But a good place generally costs you upwards of 75 lakhs across all major cities. So you would not want to do that. You can park your money in REITs. It works well as a strategy. So you get around 8 to 10% around it. So there are premium tenants there. You get a decent amount. It's commercial property, so you'll not get great commercial appreciation, but then you still make some money out of it. Then the third level is mutual funds. You can take a systematic withdrawal plan. Now, how would it work? Let us say you have 1 crore with you. You want an income, say, of around 80,000 a month.
Correct.
So you park in the 1 crore in an equity fund or a balanced fund, a large cap fund or a balanced fund. I'll be even specific about categories there. Wait for a year, because if you start taking a SWP immediately, you'll have to pay short term capital gains at 20%.
Okay, but what if you like had to give me an like
I'll give you an answer.
explanation? Yeah,
You
like
have
a
to
little bit
wait for a year.
understanding.
After a year, if you start taking the income, then you have to pay only 12.5% tax. That's the long term capital gains tax.
Understood. Okay.
So that saves you 7.5% in taxation every year, every month rather, because you're getting the income on a monthly basis.
Right, right, correct.
So that also works well. Last but not the least, you should have something which takes care of inflation and lifestyle related expenses. So you should have something which takes care. Let's say you want a car upgrade every 7 8 years, if not 5 years. So you should have some capital invested in through a fund or a PMS or AIF, which compounds over a period of time. So that helps people. So this is the 4 tier approach which we follow. So to sum it up, I'll say first is you start the first layer of the biryani is fixed income. Start with a dal roti. Second is focus on REITs or rental property. Third part which you could also consider in the process is mutual funds, SWP, systematic withdrawal after 1 year you have been invested in, because that helps in tax optimization. Last but not the least, you should have a corpus which is dedicated to growth over a period of time. So when you have that corpus with you will be able to be more comfortable during times when things are not so good, like a default happens on debt or something goes wrong with crypto.
So you have that safety
You have the
net
safety
with you, which helps you with different
which
things in
helps you
general.
with different times. Or the
Right.
business is not doing great, you are investing in it, but it, you know that will be a long term payoff, but then it's not doing great immediately. And it might take 1 or 2 years or a couple of years to rework and rethink before it gets to an optimum shape. So all these things help you with that when you retire or when you're looking at passive income also.
Makes sense. And when we talk about the passive spaces, what do you think? I mean, like you nicely bifurcated the four tier and the four layers of how one should be focused on. That's tier one, tier two, tier three, tier four, and we have added different components. Do you also recommend people, getting into like trading, go to stock markets, go for all these insurance policies as well? Do you think that should be a part of this, or
So
that should not be a part of this?
honestly, annuities are good. Annuities give you similar returns in terms of like what an FD would give you. So one approach could be you could invest in debt funds as a category. So which is why we said fixed income is a category. Annuity will come in that category.
Got it.
So even I have
So,
an annuity, so that helps me. That would help at some point in time in having a regular income which takes care of your dal roti or bread and butter expenses.
so
So
how long did it take for yourself to actually get into that phase? Like when you can say that, yeah, you have qualified or you are at that place wherein your passive space works for you, even if the active space does not work. I mean, you know that you can at least survive with the passive, and even if there is no active side on it.
see, there are 4 levels to it. One is financial survival, which is your incomes meet expenses. Second is you have financial security, where you have 6 months to 1 year of emergency expenses, okay, of fixed expenses.
Correct.
Then is financial freedom, which is 25 times your annual expenses.
Okay.
So let us say your annual expenses are 2 lakhs a month. So you multiply it by 12, that is 24 lakhs. You multiply it by
Right.
25, that becomes 6 crores. It's simple math. So if you have 6 crores, then you're financially free if your expenses are 2 lakhs a month. If you have 1 lakh
Correct.
a month as an expense, for most part of it you are. But then what happens is, as you grow older, there is something called as medical inflation and lifestyle inflation. You don't want to
Right.
reduce the lifestyle and you or in your medical expenses also keep going up.
That keeps on happening, absolutely.
So as per RBI, the data, as per their data, 11% was the inflation number for medical, and for lifestyle inflation, it's again 10 to 11%. Your basic dal roti is 5 to 7%, depending on which crop got planted when and whether flood happened there or not happened there, whether oversupply, demand, those kind of factors are juggled about.
Understood. That makes a lot of sense. Like I think you've added and incorporated all these factors very nicely into how you explain things. And like I loved how you've made simple math. So anyone who wants to survive, technically they need to, within a certain time, acquire, let's say, 6 to 10 CR for,
Depends on the lifestyle and where you're staying. For example, let's say you're staying in a tier 3 city. Your expenses say are 20,000 right now. So for you to qualify right now, you'll say 20,000 is there, 2 lakh 40,000 multiply by 25 is 60 lakhs. You cannot superimpose an urban definition there.
right. But I think even most of like tier 3 becomes a very understanded because in terms of facilities and resources as well, but most of the people for the kind of growth have started migrating to so tier 1, tier 2. So I think the standards that
It
apply over there are the
was a
same
statistic
standards.
which I came across recently that 50% of the world population is living in cities.
Right. Correct.
So take a median in terms of India sense is that you take a median of 50,000 rupees a month as expense
Hmm.
across major cities. So you multiply 50,000 multiply by 12 is 6 lakhs. You multiply it by 25, it is 1.5 crore. So if you have 1.5 crores, you are financially free.
But then you have to start investing as well, right? I mean, it's not just you just acquired that, but then you need to diversify. So as you mentioned, we are correlating it now with your first CR and then diversifying it into
See what
so that
happens
it
is,
like it works for you now.
you build a solid foundation with the first 10 crores,
Got it.
which gives you a mix of growth as well as income. Now that structure could be different for different individuals. Some people will say I want growth at 80%, income at 20%.
Could be, absolutely, yes.
It could be 60% for somebody as growth and 40% for income. Depends on unique circumstances of the individual.
Correct, absolutely, yeah.
Beyond that, you look at risk maximization or return maximization, or you're chasing returns. But the broader idea you have to look at is you have to beat inflation first. That is one. We have a unique tool called as a wealth score. It's available on my website. If you type Ashiana FinServ and wealth score, you will get the data. You can put in your details there. It will show you whether you're beating inflation. It will give you a free report as well. So it's a software which has been developed by us internally.
Wow, that's interesting.
So that is what somebody could see whether they're beating inflation or not. Assuming you're going above 10 crores and you want to maximize your returns, you define your risk capital. Now, how should you be defining your risk capital? Let's say you have a corpus of 10 crores, for example.
Correct.
Now your earning on 10 crores is 15%, for example. So your annual risk, extreme risk taking capacity on some part of your money would be around 1 to 1.5 crores. You can take an extreme risk, like invest in startups or be an angel investor or invest in VC funds or go for a series A kind of a structure jointly with other investors. So that way your capital is not hit and you have an upside provided you're open to it, but the risk tolerance we have seen is practically uh, not worth talking about. Investors, when they sign up the term sheets, they have a different reactions. When they see a drawdown, they have a different reactions. Or a write-off or a margin call, they have a different reaction. The
Right.
risk profile suddenly says, I have become conservative. How can you recommend such a thing to us? Sir, you have signed the papers. So then they say that yes, we have signed the papers, we have understood. So now what we have done is we have added another layer. Let's say the market falls 50%. Would you still have the same risk profile?
Yeah, makes sense. So, I'd like to understand this. I mean, someone did once tell me that the best way is to buy and sell businesses if you have a corpus with you. So, do you think that buying, selling startups or businesses or investing into that space also
In the game,
helps
if you
you?
have above 100 crores, you could do it. 100 crores of risk capital.
You should not do it, or you cannot do it at
No,
the.
what I'm saying is, let's say you have 100 crores of risk capital.
Correct.
Then you can be in that game.
But one should not experiment it unless they have touched that mark.
Don't experiment it because what happens is it's a very, very intensive game. You can lose your fortune if you lose your focus.
Right. It's not the safest bet to make.
See, it's not the safest bet to make. Sometimes we come in the newspapers that Elon Musk has some strategic investment somewhere which fetched him X percentage of return. Or say somebody who was working with Snapdeal, he has a family office and they're investing in technology startups, and those startups have created a lot of wealth for him. All Kunal Well, for example. So all these kind of people who are there, they've created wealth. They know the risk, and then they are doing it. Most of us are not aware of the risks which are there. The risk involved is write off of your capital is also possible. But yes, you could buy and sell businesses. It's an option on the plan to be rich. There are three plans. Plan to be safe is covering your medical expenses, covering your mediclaims, covering your emergency expenses. Plan to be comfortable is taking care of your retirement, of your kids' education, of any bucket list which you may have, like may want to travel the world, or you want to buy a dream bike or a dream car. All those things are covered in your plan to be comfortable. Then there's a plan to be rich. A plan to be rich involves buying and selling businesses. But then this
Right.
plan is subject to the maximum risk possible.
Understood. Got it. So, I mean, I think I do have a clear understanding of how we have bifurcated this area and how everything looks like. And I know we are time. It was an insightful space to actually deep dive into really understanding how to bifurcate the corpus and understand different aspects of having a certain focus and when at what point to do what. Would love to, like, since we are closing the conversation, how can anyone get in touch with you to learn more about you, and what is the one advice that you would like to leave as a food for thought?
One advice I would say top quartile sahi hai. After you've done your asset allocation and all, if you do top quartile, you get more consistent, higher returns than the index. It beats the index by 2 to 4% over a decade. So to give you an example, if somebody has 1 CR with him, and if it's a non-top quartile fund, it will earn him get a corpus of 3 crores. If it's a top quartile fund, you'll get him a corpus of 4 to 5 crores.
Right, correct.
So that is the difference between a good performer and a bad performer. You're an entrepreneur. So let's say when you see a good employee or a good intern, you see the difference. If you have a good intern, your headache is lesser. If you have a good employee who is very productive, your business zooms up. You don't have to pay attention to that many details over a period of time. You just need to oversee. So it's like that. It's a bit like that.
Got it. Thank you so much for sharing this, and we would definitely share the details for anyone who could be
My
enlightened.
details are 99301 81344, and you can email me at anirudh@ashianafinserv.com.
Perfect. Thank you so much for this conversation, and it was lovely having you and deep diving into the art of retirement and right set of investing, so that anyone who wants to achieve it on a bullish way, they can achieve it. Thank you for this.
My pleasure.